जी, अस्सलाम वालेकुम। Okay, Bismillahirrahmanirrahim. Let's start our session, and today our session is on IFRS 16. Well, Sanabi and Rizisa both are there. IFRS 16, it's about leases, very important and practically useful, mostly used standard. 16 on leases. Earlier it was IS 17 on leases, which was replaced by this IFRS 16 in almost 2018, 19, like that. So in this IFRS 16, the single lessee accounting model was introduced, and it was required that a lessee will recognize an asset and a liability for all the leases with a term of more than 12 months. If the lease term is, or the time period of the lease is more than 12 months, the lessee will recognize an asset along with a liability. And the other condition was that the asset is not of low value. By the way, we will discuss in detail that what does this mean. And then the lessee is required to measure the right of use asset in the same way as non-financial asset is accounted for, like property, plant, and equipment. And the liability, which is to be credited, is accounted for as a financial liability. The right of use asset, which is recognized, that is subject to depreciation or amortization. And the lease liability is an obligation which is settled over the lease term. We charge depreciation, and on this liability, we charge interest. So this is an overall scenario that for the lease accounting, the lessee will be recognizing a right of use asset as debit and lease liability as credit, which will be subject to depreciation, and liability would be subject to the financial charges. Whereas the lessor will be doing the same accounting as was required in IAS 17, means the lessor would be recognizing the lease, either operating or finance lease, based on the criteria, which is exactly the same as was mentioned in IAS 17. The operating lease for lessor will be taken as a rent income, will be credited along with a debit to the cash, whereas under this finance lease, the asset is derecognized along with a lease receivable which is subject to the finance income or interest income. We will look into its details in the upcoming part. As far as disclosures are concerned for IFRS 16, these are little enhanced to cover the lessor's risk exposure, particularly relating to the residual value risk. So, the main reason for issuing IFRS 16 was to identify the financial leverage for the lessee and the capital structure or the capital employed figure. Because earlier in IAS 17, we know the lessee was allowed to recognize operating lease. And operating lease means rent expense. An asset taken on lease for 2, 3, 4 years was not recognized as an asset, rather was recognized as an expense. Whereas under this IFRS 16, the lessee will not be following this operating lease thing, rather recognize under the single accounting model will recognize a right of use asset instead of the expense. So under this IFRS 16, we see an understanding of a leasing activity for the lessee. And it also addresses the concern of off-balance sheet, because when we recognize expense, the asset is off-balance sheet. Although that asset is in our use, but that asset is off-balance sheet. Whereas when we recognize an asset along with the liability, it is on balance sheet. So this was in fact the reason for identifying right of use asset under IFRS 16. Application of 16 says that the lease should be accounted for when these 3 steps are followed. Like number 1, we have to identify a lease in the contract. Number 2, we have to choose whether to apply the practical expedient or not. Then we have to separate lease and non-lease components. For this, we look into the lease contract that I will discuss with you. The practical expedients are 2. One is lesser than 12-month lease period. The practical expedient is that we can take it into the profit loss expense. and lease of lower value, we can account for this lease as an expense. So should we use this as a practical expedient or not? This is what we will discuss. And separating the lease and non-lease component, a simple concept of it is that when we are having a contract of leasing a building, supposedly, so the contract of leasing a building may have two components. One, buildings use, and the second is buildings maintenance. So these two would be different components in one contract. So we have to identify which one is the lease component and which one is a non-lease component. We will look into it in detail. So first part, identify a lease. This we have to do at inception of the contract. When
Excuse me, sir.
Yes, please.
If it will come later on, then it's okay. That what do we mean by the practical expedient? That second part, whether to apply.
Yeah, in fact, I will discuss in quite a detail. Practical expedient, the benefit would be taken by the entity for doing these acts. It is known as practical expedient. Means although not allowed, but entity can take benefit of doing so. It is known as practical expedient. We will discuss it in detail.
Okay.
Well, the contract is an agreement between two or more parties that creates enforceable rights and obligations. So, first of all, we have to look into the contract. The contract, like through this flow chart we will discuss. This flow chart may assist entities in making the assessment of whether a contract is or contains a lease. Basically, it's a lease contract or not. First of all, we'll see, do we identify an asset in that contract? For example, your entity has entered into a contract for cleaning of building. That building is already yours building. So it's a contract of cleaning a building. You are not entering into a contract in which you can identify asset, rather you are identifying a service in this contract. Okay, so first of all, we have to identify that is this an asset for which we are doing contract, like for renting a car. So here you are entering into a contract for an asset. Here you can identify an asset. So an asset should be identified first of all. If an asset is not identified, the contract does not contain a lease. If yes, then next step we will see that does the customer here is the potential lessee. Does the customer have the right to obtain substantially all economic benefits from use of the asset throughout the period of use. Like if you have entered into a contract to rent a car for supposedly 3 years, so will you be obtaining substantially all economic benefits of this car over this time period? If supposedly the rent-a-car business from whom you have taken car on lease says that you can use this car in the morning, but in the evening after 6 o'clock, you will give that car back to me. So it means you are not obtaining all the economic benefits of that car in this period of 3 years. Might be the lessor who has provided you that car in the evening will use this car for cab purposes like Uber or Cream or like that. So all the benefits you are not taking from this car, rather the supplier is also taking benefits of this car in that period. So if yes, then you will see one more thing. Does the customer, the supplier here is the lessor, the potential lessor, because yet we have not identified that it is a lessor. It will be identified once the contract is for the lease. So does the customer or the supplier or neither of these two have the right to direct how and for what purpose the asset is used throughout the period of use? For example, if the supplier puts some restrictions on using the car, it means the supplier is having the right to direct that how this car will be used. But if you do not accept those directions by the supplier, but rather you are the one who have all the rights to direct how this car will be used, then it is a contract which contains a lease. If supplier have these rights to direct, then it is not a contract that contains a lease. Okay. If both of these two parties do not have the right to direct, then we will go for another question. Does the customer have the right to operate the asset throughout the period of use without supplier having right to change those operating instructions? Means the supplier cannot change the operating instructions. Altogether, the asset would be used with the free will of the customer. Then it is a contract containing lease. Otherwise, we will look into one more question. Did the customer design the asset in a way that predetermines how and for what purpose the asset will be used throughout the period? If the customer have designed this for its own purpose, then it is a contract containing lease. If not, then it is not a contract containing lease. Overall, what we have learned from it is that therefore there should be an asset which we can identify, first of all. When we say an asset is to be identified, it means explicitly specific asset should be there in the contract, like a car or a building or furniture or a machine. Okay, so an explicit asset should be mentioned in the contract. If not, implicitly we should be able to identify an asset in that contract. implicitly specified at the time that the asset is made available for use by the customer. What does this mean? It is very important concept. Means that supposedly, here I give you an example. Supposedly, you are a pharma company producing supposedly injections, and you require its packaging. For packaging, you have outsourced to another company, and that another company will be giving you all the facilities of its company for your entity, and you are paying a fixed amount for using all the facilities of that packaging company. Because of the size, the pharma company, the size of the packaging company, all assets are in your use. Or in a way, all assets are serving the pharma company for the sake of its packaging. So implicitly, the packaging company will be treated as an asset of the pharma company, the complete packaging company, because it is an implicit asset, the benefit of which is being 100% taken by the pharma company. Well, the next thing is, a portion of the asset can be identified if physically distinct. Supposedly, if in that pharma company, we say there are 5 machines and 3 machines are being used for the production of your pharma company, the packaging company is having 5 machines. 3 machines are being used for the packaging of the pharma company. Rest of the 2 machines are being used for the other purposes. So we can distinguish 3 out of 5 are your assets. So an identified asset cannot, however, simply be a portion of assets capacity. If it is the capacity only, like for example, the capacity of one machine is producing 1,000 packets, and you are utilizing supposedly 30% of the capacity. So the capacity doesn't mean that you are identifying an asset unless the portion of the asset's capacity is physically distinct, or if the portion of the capacity is substantially all of the asset's capacity, like 90%, 95%, etc. The other thing in this identification of asset is, which is very important, that intangible assets cannot be accounted for as an asset under lease or right of use. For example, a lessee may, but is not required to apply this standard to leases of intangible assets other than those described in paragraph 3E. 3E is the paragraph, rights held by a lessee under licensing agreement. Means the rights under the licensing agreement cannot be leased within the scope of 38 for such items as motion picture, films, video recordings, plays, manuscripts, patents, copyrights, etc. All these are the licensing rights. Say if you are an entity and you are approaching me to use my intangible asset, and for which you would be giving me a lease rental, it is not allowed if that asset is license based. Whereas if that is not license based, then maybe this IFRS 16 may apply on that. I have elaborated over here. It means the rights or the licenses to use intellectual property of the other entity cannot be identified as an asset or the lease contract. Question arises, then which type of intangible assets can be leased out? Here I give you an example. Suppose there is a player who is registered with a club, and it is Club X. So this player is playing with Club X. There is another club, which is Club Y. This Club Y is requiring the services of this player so that this player plays for the Club Y. Here it is not a licensed intangible asset. These are not the licensed rights that the Club Y would be entering into leasing. Here, this player who is registered with Club X will be playing with Club Y, and this Club Y will be entering into a lease contract with Club X for this intangible asset. This is allowed. This can be taken under this right of use asset and lease liability accounting. Whereas copyrights, patents, trademarks, all these are licensing agreements. These cannot be taken under this IFRS 16. Here, I'll give you a few examples. Like a customer enters a 10-year contract with a supplier for the right to use a specific amount of capacity within a cable connecting Hong Kong to the Tokyo. Supposedly, you are an entity and you need to transmit your data to Tokyo. You are having an entity in Hong Kong. So from Hong Kong to Tokyo, there is a cable which is connecting these two cities. And you are using services of transmitting data through this cable. This cable contains 15 strands, whereas you need only 3 fiber strands for transmitting your data. So this is the capacity that you are using. Capacity. You are using 3 by 15, like 20% of the capacity you are using of this asset. This will not be taken as a lease contract, rather it would be a service contract. So the contract does not contain a lease as the capacity specified is not physically distinct, and it does not represent substantially all of the underlying asset, as the capacity is only 20% of the total capacity of the cable. If the contract specifies an amount of capacity equivalent to, say, 14 fiber strands out of the 15, then it is approximately 94%. Then we can say that an asset has been identified, which is the cable. Okay. Then there is one more thing. The supplier does not have the right to substitute the asset. if the supplier can substitute the asset and the benefit goes to the supplier, this contract will not be taken as a lease contract. For example, you have taken Honda car from a supplier for your use for 3 years, supposedly. After 6 months, the supplier approaches you and asks to give this Honda car back and get this Toyota, which is of the same size, like it is 1.8 L, and this is also 1.8 L. And with this substitution, the supplier will get benefit. Would be getting more rental for Honda. So he's giving you Toyota and getting back Honda after 6 months. It shows that this Honda agreement for this Honda is not a lease agreement. Let's read these few lines. A supplier's right to substitute an asset is substantive only if both of the following conditions exist. The supplier has the practical ability to substitute. If in this contract it is written that supplier may substitute this asset. Alternate asset throughout the period of use, it is written that the supplier may provide alternate against the asset given. And the second thing is the supplier would benefit economically with this substitution. If it is so, then the arrangement would not be a lease contract, rather a non-lease contract. There can be a substitution right, but if the lessor might incur substantial cost, supposedly, if there is written in the contract that lessor can substitute the asset, but for which in the contract it is written that if the lessor gives a substitute to that asset, then the lessor will pay a heavy amount. So in that case, lessor is not getting benefit for this substitution. So that heavy amount, the lessor will be bearing because of this substitution, means that lessor will avoid this substitution. So that's why it's like written over here that if it does not give benefit to the lessor, then it is a lease contract. But if the substitution gives benefit to the lessor, then it is not a lease contract. Then comes right to obtain economic benefit from the use. For example, either directly or indirectly, the asset that you are using will be giving all the rights to use this asset to the lessee. The primary output of this asset, the byproducts of this asset, or even other economic benefits from using the asset that could be realized from a commercial transaction with a third party, means subleasing. You may sublease this asset to any other person. So all the economic benefits throughout the period, if you are obtaining, then it is a contract containing lease, otherwise not. There is a small activity in which we see that the entity has signed a contract with the ship owner. There is ship for the transportation of cargo from Dubai to China on a specified ship. The specified ship is identified for 3 years. So that specified ship will be yours for transporting your goods to China from Dubai. The ship is explicitly specified, okay, good, in the contract, and ship owner does not have substitution right. This is also good. In the contract, it is outlined that the cargo will occupy substantially all of the capacity of the ship. Okay, it means this ship will not be used by any other person. So till here, the ship is identified and will not be substituted and will be occupied by your entity. The contract specifies the cargo to be transported on the ship and the dates of pickup and delivery. Means you are not directing its usage. Which type of cargo you can ship, your supplier of the ship will tell you, means the lessor will tell. And the date of pickup, on which dates that cargo can be delivered, can be shipped, the supplier will tell. And its delivery, the supplier will tell. It means you being lessee are not independent in directing how this ship will be used. So the ship owner operates and maintains the ship and is responsible for its safety. As per the contract, client is prohibited from hiring another operator for the ship or operating the ship itself during 3 years. So what is the conclusion? The conclusion is that this does not contain a lease. Why? Because there is an identified asset explicit in the contract. The ship owner does not have the substitution right to substitute the specific ship, and also entity has the right as per the contract to obtain all benefits from the use of the ship during the period, but the client does not have the right to control the ship because as per the contract, the use to direct how and what purpose the ship is to use is held with the ship owner. How and for what purpose the ship will be used is predetermined in the contract, and the client has provided no right to change how and for what purpose the ship is to be used. Therefore, this contract is not a lease contract. The lessee cannot recognize right of use asset along with the liability. Rather, a rental expense will be recognized for using that ship. Okay. So practically speaking, the contract reading is something which should be done carefully in order to determine the lease contract is there or not, contains a lease or not, the contract contains a lease or not. One more activity. A customer enters into a contract with supplier where the customer will purchase 100% energy produced by biomass facility. The contract specifies that the energy must be produced from this particular facility, and so the supplier does not have substitution right. Say my facility is producing biomass energy and you are using 100% facility of my factory which is producing biomass energy. The supplier receives tax incentives, means I'm the supplier for that biomass energy. I will be receiving some tax incentives which will not benefit you, rather that would be for my own benefit. You would be using biomass facility only, okay? Here, the contract transfers to the customer the right to obtain substantially all the economic benefits from the use of underlying asset, because the customer has exclusive use of the primary product of the facility. Although the supplier obtains economic benefits in the form of tax incentives, these derive from the legal ownership of the asset, not from its use. So if I'm getting benefit of tax from the government, It does not have any concern with the usage of the facility. The benefit of the usage of the facility is 100% going to you. Therefore, this is a contract that contains a lease. Okay. It is an implicit asset that you would be recognizing in your financial statements as right of use asset along with the lease liability. Now comes practical expedient. Practical expedient means the benefit that you can get because of a provision in the standard. It is known as expedient. So the benefit that the lessee can get is there are two exemptions in the presence of which the lessee may opt not to recognize right of use asset and straightforwardly charge the rentals as operating expense. A lessee may elect not to apply the lessee accounting model to the short-term lease, which is lesser than 12 months and does not contain purchase option. For example, you have entered into a lease contract for 6 months or lesser than 12 months for rent a car. In this case, you are not required to, you can get the benefit of not recognizing asset and its depreciation and its lease liability, etc. Rather, whatever the rentals you will be paying, straightforwardly debit to the profit loss as expense, credit cash. The second part of this practical expedient is that the leases for which the underlying asset is of low value. Low value means the asset that you are taking on lease is laptop or a printer or a small item of furniture, etc. Like in countries, it is considered as if it is lesser than $5,000, like in UAE especially. But it is any amount that you can decide, means the management can decide which is of low value, of not such importance for the entity. Especially the standard has elaborated few items like laptop, etc. The very important point the standard has discussed over here is the low value should be the value when the asset was new. Means not the second hand, third hand, fourth hand asset. When the asset was new, if that asset was of lesser than 5,000, remember this 5,000 is not mentioned in the standard. This is just a matter of judgment. Okay, professional judgment. So when we are determining short-term lease, this lease will be determined by class of underlying asset. Means land and building, furniture, motor vehicle, these are the classes of asset. So we will see that land and building is taken on lease for lesser than 12 months, or car is taken on lease for lesser than 12 months. So it will qualify for this practical expedient. Whereas this election is not made on class of assets basis, rather on lease by lease basis. For example, if the entity has taken 100 laptops on lease, now it is not a low value. It is not a low value because in one lease agreement, we will see the lease agreement is of low value or like 100 laptops. These are not of lesser than $5,000. So it is not of low value. It does not qualify for the low value. So important to note, company management is independent to opt for this treatment. The management will take this decision. They will be opting for this or not. The lessee shall recognize the lease payments associated with practical experience as an expense on either a straight line basis over the lease term or another systematic basis. Means the old version of operating lease will be used over there. Will be followed. It will be accounted for as operating lease as we did in IAS 17. Lease term. The next thing which is very important, we have to identify the lease term in terms of either it is lesser than 12 months, means short-term lease, or more than 12 months. So lease term is the non-cancelable period for which a lessee has the right to use an underlying asset together with both periods covered by an option to extend. It will be included in the lease term. The lease, if the lessee is reasonably certain to exercise that option, or the period covered by an option to terminate. There is an option written in the contract that the lease can be terminated. Option to terminate the lease if the lessee is reasonably certain that it will not be exercising that option. So again, that period will be added into it. We will look into a few examples to understand this concept. By the way, the lease may be split into primary period and the secondary period. In some cases, the lessee might be able to exercise such an option with a small rental. Means, in fact, the secondary period is the period for which the lessee can enter into an extension. So for that extension, the lessee might be able to exercise such an option with a small rental or even no rental. Therefore, if it can be extended with small rental or with no rental, it will be termed as secondary period. If such an option exists and it is reasonably certain that the lessee will exercise the option, the secondary period is part of the lease term. Lease may allow a lessee to terminate the lease before it ends. The period covered by the termination period is included in lease term if it is reasonably certain that the lessee will not exercise the option. So if, like, let me give you examples through activity, then it will be clear. Supposedly there is a scenario. The lease is non-cancelable for 3 years period from commencement date, after which the lessee then has the option to extend the lease for a further 2 years period. So means it could be 3 plus 2, but we have to see that would this 2 is reasonably certain that the lessee will extend. If it is reasonably certain, this will be termed as secondary period. So we have to see, should it be taken as secondary period or not? So after which the lessee then has the option to extend the lease for a further 2 years. Lessee is reasonably certain that it will not exercise. If it will not exercise, then it means it is not a secondary period. Only the lease is for 3 years. The lease term is 3 years. The lease term is 3 years. Next scenario. It's scenario 1, scenario 2. The lease is for 1 year, non-cancelable period. At the end of the lease term, the lessee has the option to terminate the lease. Means after 1 year, the lessee has the option to terminate the lease. The lessee is reasonably certain that it will exercise the termination option. So it means the lease term is for 1 year. But if there would have been a certainty that he can extend and there's a certainty that he will extend, then obviously secondary period will be added into it. Third scenario. The lease is for 10 years period, during which the first 7 years is non-cancelable. At the end of year 7, both the lessee and the lessor have the option to terminate the lease. Lessee is reasonably certain that it will not exercise the termination. But means you can say over here, since lessee will not terminate, it means that it should be included, the secondary period should be included into it to make 10. But what if the lessor terminates? So it means if the lessor has the right to terminate, then lessee cannot consider that period as a lease term. The lease term is 7 years, not 10 years. Got the point? Well, there is another activity. Sample company, who is the lessee, enters into 8-year lease of a machine to be used in manufacturing parts for a plane that it expects to remain popular with the consumers until it completes development and testing for an improved model. So the cost to install the machine in lessor's manufacturing facility is insignificant, means not significant. Sample company and lessor each have the right to terminate the lease without a penalty on each anniversary of the lease commencement date. Each anniversary means after each 1 year, both have the right to terminate. The term is 8 years, which is written in the contract, but after 1 year, they can terminate. The lease term consists of 1 year non-cancelable period because both lessee and the lessor have a substantive termination right. We cannot say that it's a 8-year lease. Rather, it's a 1 year non-cancelable period. Both can terminate the lease without penalty, and the cost to install the machine in lessor's manufacturing facility in C. So means even if the lessee says that I will not terminate, the lessor can terminate because there is an insignificant cost that the lessor would be incurring for that. Therefore, as a result, the lease qualifies for the short-term lease exemption, which is 1 year. So would be charged to profit as an expense. Low value. The asset which is of low value should be considered as if when it is new, regardless of the age of the asset. The assessment of whether an asset underlying is of low value is performed on an absolute basis, not on relative basis. Means not on percentage basis. Absolute basis means in currency unit. Okay. So in currency unit, we have to see this amount is material or immaterial for the entity. And leases of low value asset qualify for the accounting treatment as expense, already discussed. And the assessment is not affected by the size, nature, or circumstances of the lessee. There is an activity which is very much pertinent to the significance in terms of absolute and relative. Like an entity is having an approximately 10 billion annual operating budget. 10 billion. And is entering into a lease of a floor for which the rental would be 1 million per annum, and it is for the 5 years time period. So if we look into its relative form, it is very low, like 0.01%. So it is insignificant percentage, which can be ignored. But like when we look into its absolute form, it is 1 million, which is significant, and the use of the asset is also significant. It is a floor that has been leased out. So therefore, the lease does not meet the low value lease exemption based on the absolute information. Underlying asset of low value or not, we have to look into it. Like different lessees are expected to reach the same conclusion about whether a particular underlying asset is of low value or not. All lessees would be reaching at the same conclusion. If a lessee subleases an asset, supposedly you have leased a laptop and that laptop is subleased. If it is subleased, then it will not be termed as low value. Okay, subleasing an asset or expects to sublease an asset, the head lease does not qualify as a lease of low value. Examples of low value are tablet, computer, small items of furniture, telephone sets, exchanges, photocopier, etc. Well, now comes the third point, either to separate or not to separate the lease components. Standard says that we have to account for each component separately. Non-lease component and the lease component. But again, over here, there is a practical expedient that entity may apply not to separate if it benefits the entity. In which circumstances this practical expedient will be exercised? A lessee may elect by a class of underlying asset not to separate non-lease component from lease component and instead account for each lease component and any associated non-lease component as a single lease component. For example, you have leased out a building. Okay. And there is a security for the building for which you are also paying, and cleaning of the building for which you are also paying. So altogether, you are paying for the building, security, and cleaning. This is non-lease. This is also non-lease, and this is the lease component. If you are paying altogether one single amount and you have bargained it, suppose the rental is 3 million for this building, you can go for a practical expedient not to separate these non-lease components from it and altogether take it as a lease contract. Okay? So it all depends what is the management's decision. By the way, the standard IFRS 16 clearly draws a line between the lease and the service contract. Okay. So leases will be brought on balance sheet and the service contract would be off balance sheet item. Now comes accounting. The accounting part, as we have discussed, that at the commencement date, the lessee shall recognize right of use asset, debit, and lease liability credit. The lease liability would be calculated at its initial measurement by working out the present value of the future lease payments. Whatever lease payments include the amount payable by the lessee to the lessor, except the variable lease payment. Except the variable lease payment. So all the payment that the lessee promises to pay to the lessor is included in the lease payment. It, by the way, includes the guaranteed residual value that the lessee agrees to pay in terms of the residual value, or it also includes the bargain purchase. At the end, the lessee promises with the lessor that a minimal amount the lessee will pay to purchase that asset after making all lease payments to the lessee, to the lessor. So the lease payments shall be discounted using the interest rate implicit in the lease. By the way, this discount rate is used which is in fact known to the, this is IRI, interest rate implicit in the lease. This is lessor's interest rate, which is known to the lessor. If lessor does not tell this rate to the lessee, then lessee will use incremental borrowing rate. This can also be used as discount rate, which is IBR. This will be the rate at which lessee can borrow from the bank for the same conditions as mentioned in the lease contract. Means the lease term and the asset condition, etc. So the rate that lessee's bank will charge is known as incremental borrowing rate, whereas the lessor's internal rate, it is lessor's, it is IRR for lessor. It is lessor's IRR, which is known to the lessor only. If he does not reveal it to the lessee, then lessee will use IBR. Earlier slide was talking about the liability, lease liability side. Here we will be talking about the right of use asset. At the commencement date, a lessee shall measure the right of use asset at cost. And this cost includes the initial measurement of the lease liability as we have worked out in the previous slide. By the way, this will be debited and this will be credited. And any lease payment made at or before the commencement date, less any lease incentives received, means the payment that you make before the commencement of the lease. Over here, we give credit to the cash account. So here we give credit to the lease liability. And here we give credit to the cash account. Any initial direct cost which is incurred by the lessee, again give credit to the cash account. An estimate of cost to be incurred by the lessee in dismantling and removing the underlying asset, it is credit to the provision for dismantling as per IAS 16. Provision for site restoration or removal or dismantling. IAS 16 talks about it. So the accounting entries: right of use asset debit, lease liability credit, cash credit for the advance payment, cash credit for the initial direct cost, provision for dismantling credit. So this debit will contain these 4 credits. Okay. Next comes the lease payment, as I have already elaborated in the earlier slide. It is the payment made by the lessee to the lessor relating to the right of use an underlying asset during the lease term, comprising fixed payment, less any lease incentives, variable lease payments that depend on index or a rate only. As I have told you in the previous slide, that this does not contain variable lease payment except the lease payment. So be clear that the variable lease payment, which is not based on a percentage of price index, etc. Because the variable lease payment, which is based on the price index percentage, will not be eliminated. That would be considered as the lease payment. So it is elaborated over here. If it is based on an index, price index, or a rate, then it would not be eliminated. Excise price of a purchase option would also be included in the lease payment. Purchase option means if the lessee is reasonably certain to exercise that option or a guaranteed residual value, that will become part of the lease payment. And if there is any penalty payment which the lessee assumes that may be imposed, again, that penalty would be payable by the lessee to the lessor, therefore will be included in the lease payments. And then these lease payments will be discounted at IRI or IBR. Okay. Guaranteed residual value for lessor. What is this thing? Look, the lessee will be guaranteeing for the lessor. Guaranteed residual for lessor point of view includes any residual value guarantees provided to the lessor by the lessee, party related to the lessee, or third party like insurance company, etc. will be the residual value for the lessor. If lessor's party guarantees any amount for the residual value, that will not be included into it. So remember, a party related to the lessee, if guarantees, that will be included into the guaranteed residual value. But if party related to the lessor, will not be included. I'm elaborating over here. Party related to the lessor, if guarantee, do not include in the guaranteed residual value. Okay. Payment for non-lease component. These payments do not include payments allocated to non-lease components like cleaning, etc., unless the lessee elects to combine the non-lease component with the lease component and to account for them as a single lease component, okay, like security, etc. Initial direct cost for the lessee, whatever the commissions that lessee pays, the legal fee, the cost of negotiating lease terms, and the conditions, cost of arranging collateral, payments made to existing tenants to obtain the lease. All these are the initial direct costs, which are incidental to the lease contract. Interest rate implicit in the lease, as I have already discussed with you, it is IRR of the lessor. So it causes the present value of the lease payments and unguaranteed residual value equal to be equal to the fair value. Remember, it is very important point. Lease payments include the guaranteed residual value, as we have already discussed. And the unguaranteed residual value is also included in it. The present value of these two. Okay. Should be equal to the fair value of the underlying asset at initial stage. Okay. Fair value of the underlying asset and the initial direct cost of the lessor also. Lease payment, again, I'm saying, includes the guaranteed residual value, and here it is unguaranteed residual value. Altogether, both are the amounts that the lessor is expecting to receive, but it will not be received. So altogether, we will take present value of these amounts should be equal to the fair value of the asset today, along with the initial direct cost of the lessor incidental to the lease payments. The interest rate implicit, because this is outflow, this is its outflow, and this is again its outflow. And these are the inflows which lessor is expecting, and it was also expecting that it will be inflow, but could not get this amount. So it will also be included into it, so that the initial outlay of the fair value and the initial direct cost, which is also initial outlay. The present value should be equal to that at that rate, which is IRR for the lessor, known as interest rate implicit in the lease. The interest rate implicit in the lease is IRR of the cash flows from the lessor's viewpoint. It is the rate that equates the present value of the future cash inflows for the lessor to the amount that the lessor invested in the asset. So these are initial cash outflows. So the concept is 100% clear. Well, there is an example here. What we see is very important example. That sample company, which is the lessee, enters a 5-year lease of a floor of a building with an option to extend for the 5 years. So it is primary period and it is secondary period. Lease payments are 50,000 per annum during the initial term and 55 per annum during the optional period. All payments are at the beginning of the year. In order to obtain the lease, sample company incurs initial direct cost for 20,000, 15,000 to the former tenant occupying the floor and 5,000 for the real estate commission. Lessor agrees to reimburse the lessee real estate commission. So it means this will not be included. Only 15,000 will be included. At the commencement date, sample company concludes that it is reasonably certain to exercise the option to extend. So the lease term would be 10 years. The rate implicit is 5% per annum, and this rate reflects the fixed rate at which it could borrow. Sorry. The rate implicit in lease is not readily determinable. Therefore, sample company's incremental borrowing rate 5% will be used. It reflects the rate at which it could borrow an amount similar to the value of the right of use asset in the same currency for 10 years with the same similar collateral. So all the conditions of the lease contract would be placed in front of the bank, and then the bank will give you a rate. That rate is known as incremental borrowing rate of interest. So this is the accounting entry that we will pass over here. Right of use asset debit, lease liability credit, and cash credit. Right of use asset will be debited with the sum of these two figures along with the initial direct cost. But since 5,000 would be reimbursed, therefore that 5,000 would be credited to the right of use asset and capital. So these are the three accounting entries. You can club these three into one, but I have elaborated these three separately. Now the question arises how we calculate this 373,200. Remember, we are making 5 payments of 50,000 each at the beginning of each year and 5 payments of 55,000 each at the beginning of each year. So the very first payment that we will be paying at the beginning of year 1, for that straightforwardly 50,000 cash credit. The rest of the payments, 9 payments, will be discounted at 5%. These 4 payments will be discounted, and these 5 payments of 55 will be discounted. Okay, so that we get a present value of 373,200. Okay, so it's a simple mathematics that we can apply at 5%. So accounting that will be reflected in the ledger accounts for 23,200 debit, and net of these two is 15,000. You can say like this. Okay. This ledger account of right of use asset will be reflecting a carry forward amount of 438,200, which will be divided by 10 for its depreciation or amortization. Whereas the lease liability will be credited with 373,200. Okay, and in which we will be adding this interest expense and crediting the cash amount like this for each year. Now the concept of variable lease payment, as I've discussed with you, that the variable lease payment based on index or a rate will become part of the lease payment, whereas Variable lease payment, which is based on future sales or future profits, will not be included in the lease payment. Variable lease payment which are contingent and based on future happening or non-happening are excluded from the lease payment. Remember, the payments based on the future threshold is not termed as a variable lease payment, future threshold, like based on index or even a target gross profit. And in the same way, if interest payment comprises of fixed and variable, this fixed and variable should not be confused with the variable lease payment, because LIBOR or FIBOR or whatever the bank rate is always variable and can change. So that is not something that we will call it as variable. Okay, there is small activity which is about we say that lessee enters a 15-year lease of retail space in a shopping center. Minimum rent is 100 per annum. Means you have taken a shop from me. I'm the lessor, you are the lessee, and you are saying that minimum you will pay 100 per annum, unless the sales exceed 1,000 per annum. If the sales revenue exceeds 1,000 per annum, the lease payment will be 50,000. So should we call it as a variable payment? It depends. If the lessee has historical value of sales revenue, which is like between 150,000 to 250,000 per annum, means it is far higher than this 1,000 sales amount. What do we say? That it is not a variable contract payment, rather it is in its substance a fixed amount that we are paying, 50,000, because historically this has never generated lesser than 150,000, whereas the threshold is 1,000 per annum. Therefore, we will call it as fixed in substance. Okay. So the lease contract technically specifies variable payment in that rental payment can be 100 or 50,000. However, it is not realistically possible that the lessee will have less than 1,000 in sales based on the history with past retail locations. So in this case, there is no true variability. Rather, we will call it as fixed in substance. Okay. In this example, we see that there are no fixed lease payments. Lease payments are 5% of the annual sales. It says that the lessee demonstrated future potential to the lessor that it can generate at least 125,000 per annum at each location, on average 150,000. So although it is demonstrating that it can generate 125,000 per annum, but it is just like a sort of negotiation for the future potential. Therefore, it will be termed as a variable lease payment and will not be included in the lease payments for the sake of calculating present value for the right of use asset. Although there is a higher degree of certainty that the lessee will incur a lease expense of at least 625,000, which is 5% of 125,000. Variable lease payments that are linked to a future performance or use of an underlying asset are excluded from the definition of lease payment. Consequently, no liability is recognized for this variable. Okay. Okay, so there is a very classical example of variable lease payment that you can see. Fair value is 1,000, interest rate implicit is 10%, and total lease liability is 400 times 3, 1,200. Means you would be paying 400 fixed lease payment, along with the future sale-based payment, which is 2%. So in year one, sales are 15,000, you have to pay 2% of it. In year two, sales are 35%, you have to pay 2% on it. And year three, 40,000, you have to pay 2% on it. Along with this 400. Just have a look on this accounting statement. On 1st January, X1 lease liability is 1,000. Interest would be calculated at 10% of this 1,100. And cash will be paid 400 at the end of year one, which is the fixed payment, along with 2% of this 15,000, which gives you 300. So in total, you would be paying 700. How to account for this? First of all, right of use asset is your very first accounting entry. And the amount of interest that you have calculated is 100. Interest expense debit and lease liability will be credited. So that now your lease liability is 1,100. Forget about this 70-30 written in green, in blue and red. Just focus on this typed items. At the end, you will be paying 400 as lease liability, which includes this interest amount as well as 300 out of this lease liability. And the other 300 that you are paying, which is 2% of this 15,000, this will be straightforwardly debited the profit loss account. So how much you are paying in this year is 700. Debit 403 like this. Depreciation is okay, fine. In the next year, the balance is 700 times 10%. You get 70 and you are paying 400. Along with 2% of this 35,000, which is 700. So now you are paying 400 plus 700, which is 1,100. So as far as this 400 is concerned, lease liability would be debited. For this 700, expense would be debited. And altogether 1,100 would be credited. Got the point. And then for the year 3, Since you have 370, just 10% is, although 37, we have rounded off to 30 supposedly, and finally we make payment of 400 along with 2% of this 50,000. So this 800 and 400 will give you 1200. Accounting entry 1200 cash credit, 400 lease liability will be reduced, and 800 expense will be. So this is the concept of variable lease payment in terms of debit and credit. Well, lessee enters a 10-year lease of property with annual lease payment of 50,000 payable at the beginning. The contract specifies that lease payment will increase every 2 years in line with the increase in the consumer price index. So if it would be increasing based on the consumer price index, the CPI is 125. So any change that will be based on CPI would be included in the, because we can estimate well before time. So this is pretty much easy example in which you see the present value of the future cash flows is taken in the lease liability, and the initial payment that we pay at the beginning is debited to the right of use asset and credited to the cash. By the way, you can work it yourself. This is your homework. And its solution is there. You can go through all this thing. I will give you this as a homework. Subsequent measurement. Subsequently, the right of use asset would either be accounted for using IAS 16 cost model or revaluation model, or IAS 40 investment property. Okay, so these are the standards which will apply on right of use asset debit. After the commencement date, a lessee shall measure the lease liability by increasing the carrying amount, as I have already demonstrated in the earlier example. The carrying amount will be increased with the amount of interest, and then reduce the carrying amount to reflect the lease payment made. So altogether 400 was reduced or was debited to the liability. The liability was reduced with that 400, and it was earlier increased with the amount of interest that was, like in our earlier example, 100 in year 1 and then 70 and 30. So remeasuring the carrying amount to reflect any reassessment or lease modification, or to reflect revised in substance fixed lease payment, is also something that becomes part of the lease liability. The remeasurement may be required to reassess the liability or to modify the liability. We will discuss the reassessment and modification at a later stage. By the way, if the change is being made based on the information already available in the contract, earlier contract, that is known as reassessment. And if altogether the contract is being changed, it is known as modification. So both are remeasurement. Variable lease payments that have not been included in the initial measurement of the lease liability are recognized in the period in which the event or condition that triggers the payment occur. So this is also, we have accounted for the variable lease payment based on a percentage on future sales. We have already worked with that. So in this activity, again, it is for yourself. You will do it yourself. Lease liability at the commencement is 426,494, like this. And initial direct cost is 5,000 when arranging the lease. Sample has guaranteed the residual value of the asset at the end of the lease term equal to 40,000. Interest rate implicit in lease is 8%. So we'll work out based on 8%. And at the end, we are making payment of this 40,000. And 100,000 we are making payment each year for the lease. So ultimately at 8%, it will be reduced to nil. The interest expense is calculated by multiplying the opening liability with 8% in each year, so as to provide a constant rate of financial charges on the outstanding obligation. This type of working we have already learned in EIR, effective interest rate. So you can work it out, and the closing balance, if we are paying 100,000 each year, the closing 40,000 will be the closing balance. Anyways, lease reassessment means remeasurement of the lease. The lease term is updated if there is a change in the non-cancelable period of the lease. And this happens when the lessee exercises an existing option which was not previously considered in determining the lease term. Existing option. Or the lessee does not exercise an option that was previously considered in determining the lease term. So in both cases, the term is within the contract that was already agreed. So if the change is based on such, that is known as reassessment. So the remeasurement for reassessing the lease liability, remeasurement for reassessment of the lease liability at revised rate or original rate. So lease liabilities must be remeasured to reflect changes in circumstances. Circumstances might change over the life of the lease, leading to a change in the lease payment. For example, the lease term might change due to reassessment of whether an option to extend or terminate a lease is made, either to extend or terminate a lease is made, or lease payment might change following a rent review. Again, based on the contractual arrangements written in the basic contract. So the lease liability is remeasured by discounting the revised lease payments using the revised discount rate or original rate. So revised rate will be used if the change is in the lease term or in the option to purchase. And original rate will be used when the change is in the future lease payment or in the amount expected to be payable under the residual value guarantee. So resulting from a change in an index or a rate used to determine those payments. For example, market rent review, etc. So by the way, for remeasurement, whenever we make change, the impact I will discuss in this example. Sample company enters a 5-year lease of a machine on 1st January year 1 against annual rental of 100,000 in every year. Lease liability at the commencement of the lease was 426, 494. Initial direct cost was 5,000. The same old example. Sample company recognized a right of use asset at the commencement of the lease, which is 431, the sum of these two. Sample company has guaranteed the residual value at the end of the lease term, which is 40. Sample company has an option to extend the lease term for a further 3 years at an annual rental of 110,000. So originally it was like 5 years, but can be extended with this further 3 years. At the commencement date, sample company concluded that it was not reasonably certain to exercise the option. So the lease term was determined equal to 5 years. Remember, this 3-year was part of the original contract. So sample company will not guarantee residual value if it exercises the option to extend the lease term. It was also part of the contract. So the change is not resulting from a change in an index or a rate, therefore use revised interest rate. End of year 4, sample company circumstances have changed and it is now reasonably certain that it will exercise the option to extend the lease. Means this 3-year will be added, and since it was the decision taken on end of year 4, therefore from that date onwards the revised rate will be used, and the further 3 payments of 110 would also be included. So meeting the condition, we will be using 9% rate now, and you see the accounting is this. Earlier we were using 8% rate. After the 3 years time, after 4 years, I could write after end of 4 years. Okay. After the 4 years time, we stood at this liability, and for those 4 years, the asset was also depreciated and was at 118. So remember, this is the carry forward balance at the end of year 4, and this is the carry forward balance at the end of year 4 for the asset. Liabilities and asset are there. So what happened that since we have to remeasure this liability at 9%, 5th year rental would be 100,000, 6th, 7th, and 8th year rental would be 110,000. And no guaranteed residual value is here now. No guaranteed residual value is here. So only 110 will be paid. 9% discount rate gives this amount as its present value. Earlier, we had carry forward value of 129, whereas the revised value should be 347,195. Remeasurement adjustment of 217 is required. The carry forward balance of asset was 118. This 217 will be credited in the liability and will be debited in the asset, so that the asset would be equal to 335 now, and the liability would be equal to 347 now. Asset debit 217,565 here. Liability credit 217,565. Okay, so this one is like this. So rest of the things you can work out that now the asset not having any residual value will be divided by the remaining useful life, and this will be its depreciation. And this is the amortization table starting from the new balance for liability and working out the interest at 9%. And these are the cash flows 100, 110, 110, 100. And now there is something about lease modification. Remember, if original standard is silent about something and the lessor and lessee agree upon some changes in the lease agreement, such changes are known as lease modification. I'll take you through some activities. In this, it is not a lease modification because the change was already part of the original contract. Sample company leases a building for an initial period of 5 years with an option to extend the lease for a further 5 years. At the commencement, sample company concluded that it was not reasonably certain to go for the 3 years, therefore it was 5 years. At the end of the 4th year, the lease sample company circumstances changed and it becomes reasonable that it will exercise the option. So it means the option was already part of the original contract. Therefore, this is not a modification. This is a reassessment. Okay. And here, if the sample company leases building for 5 years, at the end of the 4th year, sample company enters into a further 3 years period. This was not part of the original contract. It is known as modification. Okay, for lease modifications, a lessee accounts for the lease modification as separate contract if the modification increases the scope and the amount for which the modification will happen is a standalone price. Exactly, if you do remember IFRS 15 discussion, the change in scope means distinct performance obligation and standalone price. Gives rise to a separate contract. So same concept is here. Okay. Well, so again, like over here, you had 1,500 square feet for 10,000. Now you are agreeing for additional 1,000 square feet for 6,000. Altogether, now you would be paying 10,000 and 6,000, 16,000. Okay. So it is the additional 6,000 is in line with the current market rate, and therefore it is a standalone price. So a separate contract would be considered for this modification. Okay. A new lease for the additional 1,000 square feet would be a separate contract. So these would be two separate contracts. And there is one more example in which there is no separate contract that would be clubbed into it. The modification does not result in new lease. It does not add to the right to use one or more underlying asset. Okay, because the asset, the earlier was a 6-year lease for 3 floors of an office block for 100,000. The interest rate implicit could not be readily determined, therefore IBR was used. Asset is written off at straight line. At the end of year 4, the lessor agreed with the lessee to amend the original lease. Therefore, it is a modification for the remaining 2 years to reduce it. So it is not adding in the asset under lease. Therefore, it is not a separate contract, rather an adjustment would be required in the earlier contract. There are a few more activities. Okay, this is again the same activity that I was discussing. You can work it out yourself. Because of the time issue, I'm just taking you over here. That this is a PDF that I will share with you containing 10 examples of lease modification. So this, out of these 10, 2 I have discussed in the earlier slides, 8 you can work out yourself. It's very comprehensive. As far as its presentation and disclosure is concerned, that we have to present it as a separate line item. And there are few disclosures which also be taken as separate line item. In terms of lease liability also, it should be presented separately and disclosed in the separate line items. Current non-current elements should be distinguished for the lease liability, and maturity analysis should also be there. Remember, the maturity analysis should be without discounting whatever the future cash flows we have committed, that would be disclosed in the notes as to maturity analysis with a band of 3 years or 4 years. That band is based on the judgment. Lessee uses its judgment to determine an appropriate time band. Like less than 1 year, you have to pay 1,000. More than 1 year, but less than 5 years, you have to pay 4,000. And more than 5 years, maximum, there was 1 year ahead. So this 6,000 was payable in the future in this band. It is known as maturity analysis. Okay. And this is its solution disclosure. Well, this was all about the lessee accounting. Now we have to discuss lessor accounting also, and it is in fact altogether the same as IS 17. And what we see in lessor accounting, I will straightforwardly take you through an activity. Now you are lessor, I am lessee. You are receiving 6 installments of 18,000 each, and there is a guarantee from my side for 8,000. So these are the lease payments, as I have discussed with you. And this is the unguaranteed residual value. Lease payments and unguaranteed residual value are discounted at IRI, whereas the fair value plus initial direct costs together, which is the outlay, as I have already discussed with you, this is the initial outlay. The difference of these two is the total amounts of interest, which when you discount this, this is the difference that you get. In a way, this 2,000 would also be equal to the present value of lease payment and unguaranteed residual value at interest rate implicit. So this present value is also known as net investment in lease. This is known as gross investment in lease, and this is known as net investment in lease. Okay, the difference is finance income. So this is what I have elaborated in fact. Okay, this point I have discussed with you. All this I have in fact discussed over here, that the present value at IRI will be worked out here. And in this activity, what we see, the lessor lease payments are here. Here there is no guarantee or unguaranteed reserve value. Altogether, the bargain purchase will become part of the cash inflows. These are cash inflows. So this is known as gross investment in lease. And these are the net investment in lease, the present value of this cash flow, which is fair value plus initial direct cost, which is cash outlay of the lessor. Subtracting this from here, you get total finance income. So this is the table that you work out in the same way as we worked out in the case of lessons. And the accounting entries would be lease payment receivable, which is net investment in lease, debit, machine account credit, and this net plus unearned financing, UFI, unearned finance income, debit, and machine credit and unearned finance income credit. What you do now, you will be receiving the lease payment each year, cash debit, lease payment receivable credit, but at the same time, this unearned finance income will be amortized and taken to the profit or loss, statement of profit or loss as your income. Okay, and same will happen each year. Same will happen each year, so that the portion of unearned finance income appearing in the lease payments receivable will also be reduced to zero, and this unearned finance income will also be reduced to zero. So this is an accounting treatment that you do for the lessor. This is the presentation in the balance sheet. So total overall summary of this IFRS 16 is for your read. And that's all. Thank you very much. Just go through all this standard once again, and do let me know if you have any confusion.